So just to kind of frame up, let me just frame up what we're going to do today. So I've spent most of my time over the last 13 years. I am a Canadian, but I've been spending the last 13 years in Asia building accelerators. We have a US perspective and a Canadian perspective. So that's kind of how we're going to frame up the panel. And I guess this first question is obviously accelerators are in the limelight. You know, we have this AcceleratorFest going on here. And there's been hundreds of investments. There's well over 1,000 accelerators now all over the world. But I guess my first question is why are accelerators so bad at picking winners? Why is that?
It's an interesting question. So I think the way we think about it is that at the accelerator level, about 50% of our companies within 2 years are gone. And that's just a function of investing kind of institutional capital at the pre-seed stage. And it's a challenging space to be in. A lot of these companies are still just getting some early traction, just getting to product market fit. So there's still a ton of risk and a ton of things that need to happen after that for a company to even get to a Series A, let alone raise a large seed round. So I think a lot of it is a function of the stage in which we operate. And then a lot of it's also a function of the mentorship and the downstream capital introductions, a lot of the other things I think we'll chat about soon.
Okay. John.
I'm English, and so I shouldn't really talk about baseball.
Okay.
But when I first started watching baseball, I saw these guys getting paid tens of millions of dollars a year.
Yeah.
And they couldn't even hit the ball. They played 1 in 3.
Yes.
And those are the best. And I think it's a similar thing when it comes to startups and investing in accelerator companies. This idea that every company that goes in is going to be accelerated and is going to succeed sort of fails to understand physics. Acceleration is a relative vector, and therefore if everyone accelerates, it looks like you're sitting still.
Yeah.
And so the idea that we've always thought about is that what we're looking for is what is the one company in the cohort that accelerates away from everyone else. So maybe 1 or 2. So if you can hit 1 or 2 in 10, that's actually what we're looking to achieve, as opposed to getting everyone to succeed. And I think the other thing is sort of using the skiing analogy. If you don't fall over, you're not pushing it hard enough. And I think that's the other thing which we're really trying to always think about.
Now, from a Canadian, I'll just continue on with John and come back here. Obviously, with Real Ventures, you guys have had a pretty good track record here in Canada, right? Is there a secret sauce that you could share? There's a lot of people running accelerators that might not have the track record of Real Ventures or 500 startups. Is there something you can tell us about picking the winners, some filtration? Is there a magic layer that you guys have?
So the first thing is having a long-term view.
Okay.
Have a long-term view. Don't expect overnight success. The one thing that I think we've certainly, and this actually happened more a little bit by luck than by judgment, was the way in which we fund it. We are a venture capital fund that, for those people that know venture capital funds, we take a portion of our management fee and we pay for the people that run the accelerator, we pay for the events and the activities. And the money that we invest comes from the fund. So, and it's probably only about 3% of the capital under management is invested. So for us, it isn't that we have that ability to not succeed quickly and still have long-term sustainability. So I think that's the most important thing. Thinking about, and when we went into this, we didn't think about the future. We were as entrepreneurial as anyone else. But thinking, it's probably going to take 7, 8, 9 years before the returns start coming back. So having sustainability and knowing how we're going to be sustainable, that was, I think, the first thing that I would suggest. You really need to take that seriously. The second thing is, although it probably is going to take a long time, you need to be ready for when success strikes. There was an advisor to the University of California Pension Fund, and he said something like, lucky investors look smart.
Yeah.
Smart investors build brands. And so from an accelerator point of view, you need to be consistently building your brand and ready to take advantage from a brand building point of view of any success you get. And you need to maximize that because success begets success.
Sure. And that helps with your recruiting as well, obviously, right?
Absolutely. And it is that idea that it becomes a self-licking ice cream, so to speak.
Yeah, absolutely. Arjun, what are your thoughts with 500 startups?
Yes, I think maybe piggyback off what you just said around building brand, because I think that's really important and doing it in an authentic way. So I think the way to really build a brand is to understand, who are the people that are in play there. So finding the founders, being able to create really good content for them, getting on a plane, getting out of the particular area. At least for us, we bring folks into the Bay Area, but may be applicable for your region, whether it's just outside of wherever you are. But I think putting in the face time, getting out there, speaking, engaging, meeting founders where they are, and then creating content and events that allow for folks to really learn, founders to learn the things that are important for them to scale. And so being able to put that content out there, I think, matters a lot in attracting great founders. And then lastly, of course, is getting the founder community that you have, your successful founders, to engage with you. Have them come in and speak at the accelerator itself, or have them come in for LP days, or just engage with the community on your behalf. Make sure the PR team is thoughtful about ensuring that every time that company goes on to raise a subsequent round of financing, that you're mentioned as a company that accelerated them. So all of these kind of blocking and tackling tactical things on the brand make a big difference in continuing to attract strong deal flow. And then, of course, it's the partners, the EIRs, the venture partners, the folks that you have surrounding the accelerator and their networks and what they're doing out in the world makes a big difference. So just some quick thoughts off the stuff.
Now, I guess my next question is around the setup. Obviously, Y Combinator, Techstars, everyone knows about them, and when you look at all the other accelerators out there, their first thought process is, let's copy them, right? Let's do a 12-week program. Let's have a mentor-led week-to-week development culminating in a giant demo day, right? Many have failed. Lots of them have failed, and a lot of people complain about, demo days being a lot of pomp and circumstance. But where do you see that going now? What are your thoughts on that, right?
I can take that. So I think that a lot of building a great accelerator is about understanding your local market, and I think in many cases, just heard a great story about someone, instead of doing a demo day, they'll get out on a plane and do kind of a tour and go meet investors where they are. So I think there's a lot of different ways to understand what does the ecosystem support, what's the best way to do it, where you may not have a lot of mentors in a particular ecosystem. How do you structure it such that you can fly folks in? So the family in Paris, for example, does a great job of this. They kind of regularly bring in mentors from all over the world to spend time and engage. And so I think, copying point blank is especially challenging in Silicon Valley, just because it's a very unique ecosystem and it's been around for now, called several generations of entrepreneurship. So I think being super aware and understanding of your current environment, how you can leverage the best practices for mentorship and for downstream capital is particularly helpful to make sure you don't rinse and repeat and then destroy. Kind of doing that.
John.
I would say that even observing something doesn't really allow you to copy it. What you see on the surface is the output, and what really matters when you're crafting an accelerator program is what is the input. I would say at Founder Fuel, almost some people criticized Founder Fuel in the early days because our demo days are the best demo days in the fucking world.
Okay.
Even David Brown was blown away by the Founder Fuel demo day last night. It is a high production event, and the reaction to that was criticism that, they just teach you how to pitch. And what people who were seeing that from the outside failed to understand was the crucible that the entrepreneurs had gone through in order to be able to deliver that pitch, effectively set them up on a straight line for where they needed to go. And so it was the process. And the real reason that we did the demo day was to give them the pressure of going through that process.
Yep.
And the ancillary benefit that it gave was that it set the bar and raised the profile and created something for the community to engage with, the community to thrive around. And that was really the dual purpose of the demo day, and it achieved it many ways. So I think whenever it comes to developing your program, you need to be very mindful of what it is that you expect from each aspect of the program that you put in place, and not simply look at the fact that someone else is doing it and copy it for the sake of it.
Yeah, interesting.
Yeah, I think that point around demo days is so valid. I think our demo days are an opportunity for LPs, for the press, for corporate development, for BD, for the founders, of course, and it's much more than just a few companies presenting on stage, and it's an opportunity for us to connect with our community. So really second the importance of that.
And I think the thing more than anything I think we try to do is try and have an impact on the individuals' lives that go through the accelerator. Companies are individuals. They're made up of individual emotions, individual passions, and team and collective emotions and passions. And what really matters is that when they come out of that, they know themselves better. It's only by knowing themselves that they will understand their capabilities, they'll understand their weaknesses, they'll understand the gaps. And then they need to be able to understand, how can I find other people to fit those weaknesses and those challenges and those gaps. So focusing on the individuals and making them better people is as important as focusing on the company.
Okay.
Yeah, there's a new venture fund called Fearless.vc that's focused, their core thesis is actually around this concept, so it's cool to see that company.
Let's dig a little bit deeper on that, because on the topic of curriculum, right? Typically when you go through an accelerator, there's, every week we're going to talk about, today it's advertising, social media marketing, product market fit, et cetera, et cetera. How do you connect the dots with what you just said? Like, changing people is what you just said is very powerful, right? So how are you able to do that?
I think curriculum is very important, and I know you've got a hell of a lot of experience in what we were talking before in terms of building curriculum. I believe that curriculum is about two things. One, providing core knowledge that is not really debatable, but is more factual. And it's essential to your ability to understand and process the information you're going to get. The second thing about curriculum is creating opportunities for interaction that enable challenges to people's current thinking in safe environments. And when I say safe environments, I don't really mean they're safe, but that they are environments which you've specifically created in order to try and get a reaction from a person. So they need that core knowledge, but we try and find different techniques. Sometimes it's the arm around the shoulder technique. Sometimes look, they're not listening to me, bring in a mentor technique. Some of it is I'm sorry, we're going to have to kick you out of the accelerator unless this changes technique, because at the end of the day, the biggest issue and the biggest barrier to success for most people is their own blindness to what it is that they're not doing. And you need to use techniques combined with curriculum in order to get over that blindness.
Got it. So.
Yeah, I think that's spot on. I think one of the other techniques, I think hit a lot of them, that we use is just really asking deep questions about belief systems. So why do you believe that? Why do you think that? Where have you seen that? Why are you deciding to move in this direction? And just kind of following that Socratic method down, a line of questioning that really helps people question those core beliefs so they can have the self-awareness that they then need to be able to make the changes that they need to accelerate quickly. And so a lot of that comes in these kind of one-on-one meetings with in our case, we have EARs and venture partners, or the folks that spend time with them on a week-over-week basis. And we talk about this collectively as a team, is how do we kind of dig in fast so that these companies can move quickly past these blocks. And so those first 3 to 4 weeks are really critical. We want to make sure we're spending time regularly so that we can find what those blocking items are and start to push past them fast. So that maybe just to tack on a little bit more there.
So let's talk a little bit about tracking the performance of a startup, right? So you're into your program, you're trying to have a valuable experience, life-changing experience. How, for the people that are developing their programs, most of the people in the room, what are some of the KPIs or metrics or stuff that you guys like to track? Because what I've observed with a lot of accelerators, they're trying to track everything. It's thrown onto a dashboard. No one's actually doing anything with this data, and it's the typical big data problem, right? Where you're tracking everything and not measuring enough to act on what you need to do, right? So what are your thoughts from that perspective on tracking and performance metrics?
Yeah, so we have one very specific thing we do. It's called the metric that matters. So we sit down with our teams and decide what's the one metric that matters. When they come into the program, we really focus in on that. One, it's figuring that out, so that usually takes a little bit of time to really suss it out. And then being able to track that very clearly, and then we work with our companies to track it over time. So that's what we use to have our companies track themselves during the course of the program. But as the folks who run the accelerator, we do kind of a check-in 4 times over the course of the accelerator with our team, and we use one number to just kind of identify where we think they fit in a scale. It's a scale that we've developed over time. So that's kind of our methodology to answer maybe both sides of that question.
John.
I think that Founder Fuel is relatively weak on tracking metrics. I think that is because Founder Fuel has historically been willing to take companies a lot earlier than perhaps certain accelerators. I don't know if it's true, but I've certainly heard it said of Y Combinator that all they care about is growth, growth, growth. So it's find your metric, and every day it's almost like just grind out the sales, grind out the sales, grind out the sales. Maybe that makes sense because of the stage of some of the companies that are coming in there. Maybe that's just the methodology that they work to. But from our point of view, or from my point of view, the biggest issue with companies coming to accelerators or going on a venture-backed path is they don't have a clue what it is that their value proposition relative to the competitive landscape truly is. So, and even that statement seems simple on the surface, but people can't really answer it in depth. And we spend too long, but it's essential, on actually just peeling the layers of the onion. I mean, asking the why, and peeling and peeling and peeling, to the point where, when it comes to actually understanding the metrics, I don't even know if there's enough time to really start tracking it during the program. But what we would hope is that they can find it as soon as possible. But when they have found it, that gives them the impetus to tell the people, this is what we are tracking, this is why we're tracking it, just watch it. And I think that may well be because of the stage that we're coming in. So I'm not in any way trying to suggest it isn't important. I'm just saying that is not the most important thing for our companies.
Because it's powerful. So if I understand what you're saying, you're peeling, trying to understand why, and trying to get to that point where they actually understand what that metric is, and by doing that, they align themselves on all the other components of their business. And then at the end of your program, they have their metric, but then they also have their alignment on value proposition and all the other pieces that need to take off.
That's exactly right. The only one word which no one will have noticed that I would pick up on is that when you said that they are trying to track. It's not about that they understand. It's not like we understand the metric. And they don't. As investors, because we do write multi-million-dollar checks from our fund into a variety of companies, whether they've gone through an accelerator or not, we look upon these companies as saying, if we were going to write a check into you and we've never met you, what would we believe? So it's less about what do they believe, it's what do we believe. Now, we believe it and they believe it, that's the perfect scenario, but it's about what do we believe, and if we don't believe the metric that they're tracking, we won't let them have that. They need to continue to convince us as to why that's the thing that matters, and I think the thing we're doing is constantly saying, that doesn't matter. That doesn't matter. That doesn't matter. Or why? Why?
Interesting. Powerful. So let's switch topics a little bit on money. I know this is a topic that seems very, very pertinent at the moment. There's different types of accelerators. You have some that will drop a little bit of money for the founders, right, to get started. They get some seed capital, get a bit of oxygen. Some of them will give money and take some of it back in terms of just using the space and then leveraging that. There's other ones where you get no money at all, but you're part of the whole experience, and if there's an upside, they might invest in you. Have you guys, over the years, is there a balance now, right? Because again, like Y Combinator and Techstars have their model. Is there another sweet spot that might be interesting for the audience to know about in terms of a balance?
Yeah, just to talk a little bit about our model, we do $150K for 6% of the business, and we take $37,500 off the top that goes to support the EIR's venture partners, space, demo day, food, all the other good stuff. And that's oscillated over the years. Our accelerator program really kicked off in earnest, let's call it 4 or 5 years ago. And so that that's kind of fluctuated over the years. But I think we're just trying to hone in on that right balance between enough capital to run a tight program, have some money for marketing and sales, and maybe even make a hire through the time. And then also enough to kind of support expensive real estate in the Bay Area more than anything else.
So it's 50,000 minus.
It's 150,000.
150,000
minus 37.5.
Okay, got it. So they got $100,000 roughly, 100,000 plus, in the Bay Area.
We pay market.
Okay.
And we don't set market. 500 startups, Techstars, and Y Combinator set market. When I say we pay market, the amount of money we give is totally irrelevant to what they need. I mean, we do, it varies, but right now I think it's 100 grand for 100 Canadian for 5 or 6% was in the last cohort. It's not about what they need, it's just about market. And it's something which I say it in a way that which would suggest I don't like the fact that we're just paying market, because it really talks about valuation. And if I would go to anyone that has been through our program, not anyone, I think we've graduated 87 companies, but I would say probably 82, 83 of those would go through it again whether they had money or not, maybe even probably even pay us to go through it, because we did change their lives. And so the how much money you're giving them and what is the deal is really just about how do you entice someone to come into something that they've never experienced. It's sort of, as I said, it's just market. You need to go on to the accelerator totally unrelated to the amount of capital that you're getting. Totally unrelated. Just understand, well, look, this is market, and so be it.
Interesting. All right. So here's another slightly controversial question, but I've seen this trend. When accelerators first came to be, there was all this excitement to kind of get into an accelerator. And now that there's so many accelerators, you have entrepreneurs that are becoming a lot more picky and choosy. And when you hear the conversations, so not the people here, but if you look at the conversations that are happening with the startups, they're all kind of like being like, they might not even have an idea. It's just like a PowerPoint. And suddenly they have like opinions of everyone. You know what I mean? Like suddenly, and they're the big cheese, right? So let me ask your opinion right now in terms of the ecosystem. And obviously there's a lot more startups now, right? Everyone wants to be the new, the next Element or the next 500 startup success story. Do you think that the startup founders are getting a little too picky now? Is that something that you're seeing? It's a controversial question.
I would say it's probably a function of just having a lot more entrepreneurs. And this is probably a function of the fact that over just looking at the last 5 to 7 years, the cost of starting a company has decreased precipitously. And that means that folks who previously said, no, this is too difficult, I'm not going to do it, now say, hey, maybe if I can raise 50 grand from friends and family, spin up some things on AWS, and I can get going.
Sure.
And, so I think that creates a whole new ecosystem. Now I also think there has been, the power kind of always is oscillating between the investor and the founder, and the best founders are the ones that have that kind of power position. But I think generally, at least in our experience, and I know this is biased, I think it's been relatively balanced.
Got it. And is that in all the markets? Because 500 Startups operates everywhere pretty much, right?
That's true. I'm speaking now from the Bay Area perspective, but I think in other markets, it's particularly in emerging economies, our sense is that, at least for us, we get to see a lot of the deals. So it's the opposite. I think the balance of power shifts slightly to the investor side, particularly in emerging markets. I think if anything where we'd see it be more founder-centric would be potentially in the Bay Area, at least in our experience.
Got it.
Again, of the 89 startups we founded, which is, let's say, 250, 300 founders, I would say we probably have 20 to 30% that are always cocky, and the other 70 to 80% are always are very thankful the fact that you're willing to take a chance on them. And it's normally not the right way round. The ones that are thankful should probably be a bit more cocky. And the ones who are cocky, in all but I would say one case, should be bloody thankful. And I don't think that's changed. I just think it's human nature. As I said, people understand what market is these days. So we don't really get into many negotiations about this or about that. I think so. It's humans and it's people, and again, it's about how can those cocky ones, if you can show them, if you can get them to look in the mirror, they can become great entrepreneurs. And those ones that are are thankful, and you can show them that they have something to offer to the world and that they need to put their shoulders back. It's those changes in people's minds that really make the difference.
That's a great point. We look for coachability as one of our kind of factors that we look for, and that coachability goes in exactly both those directions. So it's are you coachable to be more powerful, more present, more cocky, or are you coachable to say you need to take it down a notch and listen? So it's awesome.
And is that part of your criteria, this coachability thing? You
That's a very specific thing that we look for and we call out in all of our interviews. We're looking for coachability.
Because usually in a lot of startups, people have a different face and a different front when they're trying to get into the accelerator. And then they kind of change a little bit when they kind of get in, and you know what I mean? So that dynamics and managing that dynamics is something you have to look out for. Interesting.
And I think as an investor, it's very hard. I say it's very hard. Maybe just as an individual, it's very hard when people constantly come to you and constantly think that you are the path to their future. As yourself, to retain a degree of humility and not be cocky, because I think we've just been through a fundraising process, and I'm happy that we have to do it. I hate it, but I'm happy that we have to raise money every 3 years, because my God, does it help get rid of any cockiness or humility I might have. But it's very, very important that you understand that it isn't just them being cocky, it's sometimes you, it's the interaction between you and them, and that you are aware of the interactions that are created between people, and how people's appearance to be cocky or appearance to be coachable is somewhat related to you as an individual and how you approach them.
Interesting. So my next question is around kind of looking forward, right? You know, we've had the typical accelerator platforms, the 12-week programs. In Asia, where I spend most of my time, in Singapore, Hong Kong, we have programs that are not just the 12-week programs. We have programs that are 2 months without a demo day. We have corporate innovation programs. There's a lot of movement happening, and what you'll find in places like Asia is there's they have to make things work, so it's a little bit less structured at times. For the people in the crowd, where do you see the future going now? You know, think about what's the accelerator space going to be like in 2, 3 years, maybe even 5 years? Where is it going to be?
Obviously, I don't really know. But David Brown from Techstars was up here on stage, and he said something which I think is very profound. I think it depends on what happens with the markets in general. I think that he pointed out, and he was very articulate on it, that 2008 was sort of the year when the accelerators really took off, and it was the end of a very bad time. Oh, sorry, yeah, it was the start of the climb back up, and we haven't had a downturn in the market since. And I think when there's a downturn in the markets, he was saying, and I 100% agree, that a lot of the accelerators that do not have a plan for sustainability will disappear. And I think in that case, those accelerators who have been luckiest or who have built the best brands will continue. And I don't really see that the methodology for the traditional accelerator needs to change. I think that the methodology for the traditional accelerator, the sort of the 12-week mentor-driven thing with some cash, I think that works and will continue to work, because the thing that drove it in the first place was the cost of a startup falling precipitously because of open source software, cloud computing, etc. And I think that is not changing. So I think you can get things up and running quickly and effectively. So I don't think that will change. So I still think there'll be a role for that, and I think it will continue. I do feel, and we've seen it. There's one thing, for example, Creative Destruction Lab, which started out of Toronto. A very interesting, different sort of model, but with different goals and objectives, which comes back to the don't copy, understand why they do it. The Creative Destruction Lab, I'm really interested to see what happens now as it expands around Canada, because the thing that I think was most powerful, that, and you'd appreciate as an educator, was how valuable it was as a training course for MBAs. It was created, from my point of view, as a training course for MBAs that benefited startups and angel investors. So I think there will continue to be innovative models, but I still think that there is an opportunity. I think that the core accelerator model will continue and is here for the foreseeable future.
Thank you.
Right. So I'll throw out kind of one crazy idea and then bring one thing kind of back to the root. So I think on the crazy idea, I'm curious just about how ICOs play into the future of accelerators, and whether, a big part of sustainability that we've been talking about is this ability for these accelerators to raise capital. What happens when that could potentially be, completely democratized through the use of coin-based offerings as a way to, capitalize things. So that's something just, out there to think about. Maybe 5-10 years that shifts how things move. But kind of taking it back to the roots, I think one of the things that a great accelerator does, and as you've seen, a lot of what we've been talking about is the very human side of things. It is ultimately about mentors, people spending time, the community that's built around an accelerator, the downstream capital, the VCs, the seed stage funds that will engage with those founders. So I think the best accelerators in the future will maintain that deep sense of community and will surround themselves by these incredible mentors who are not just coming in and out, but over time develop a real expertise around how to help founders in that critical stage, wherever that happens to be. So that thing, I think, will stay, and then we'll see lots of fun innovation in and around it.
I think the comment you said about mentors is extremely important, and I'll bring it back to the question you asked, Ash, about recommendations for structuring of accelerators as relates specifically to mentors. If you're running a program, don't think about the startup so much. Think about what your job is to do is to create the perfect environment for them to succeed. It's not to make them succeed. And the perfect environment is very much dictated by a strong mentor network. And when you talked about copying as well, so we went and visited Techstars before we launched Found the Fuel. I also spent a lot of time as a mentor at Seed Camp in London.
Sure.
And the thing which really struck me from Seed Camp in London was that their mentor days were not one-on-one mentors and trying to assign. It was always about groups of mentors. And because the idea was that you were trying to deliver the mentors an experience and a connectivity with other mentors, corp dev people, VCs, successful entrepreneurs looking for their next gig. And what that enabled people to do was, it was almost like the startups were case studies around which the mentors were having discussions, and the mentors actually got to hear each other, and you actually got to understand the qualities of a mentor, and the strength of the networks and relationships that you built made you as a mentor want to go back. And I think finding ways to do that type of stuff, so you're creating your accelerator program to give mentors a great experience, which just so happens to benefit startups.
Yeah, powerful.
We do something called Mentor Mingle, which is just an opportunity. We ensure that everyone gets together, multiple times during the course of the batch. So it's so spot on.
Excellent, gentlemen. Our time is almost up, and I know the MC is here, so I want to give him 34 seconds to use the loo if he needs to, and come back for his next thing. Arjun, John, thank you very much for your time. And